Welcome to the Times of Industry show. Today I'd like to pull the curtain and give you an insider's look into what it takes to become a successful multimillionaire early in life. Many of you know my blessing and curse. My father went belly up bankrupt 3 times by the time I was 22, with the first time being when I was just 13 years old. So I started working, I started saving up, and by the age of 16 I started investing. Without the discomfort brought about by my father's decisions that led the family into bankruptcy, who knows where my mindset would be today, because the hardships were a blessing and a curse combined. My point is that we can't worry about how we are going to start out in life, what our starting point is, since it's out of our hands. But we can figure out where we're going. I get many emails from people who want to build a financial fortress and become wealthy, but have little to no capital. And I always remind them that active income in their particular point in life is superior to passive income and investment results when you just start out. In fact, if you have a capital that is limited, $40,000 or under, you should keep 75% of it in cash until the biggest opportunity ever comes along, so you can truly deploy serious capital to it. Same as the anaconda waits for one big prey, not settling for all the small ones, just lurking and waiting with a lot of patience. Today's guest is an anaconda for sure, and I couldn't say it in a more positive way. While he still has all his hairs intact, being very young, he's already considered a legend, a living legend. And I want you to pay full attention, close attention, because your story, Marin, really resonates with everyone on this call. And we're listening to this interview because, what you can offer us is true value, and I really want to thank you for taking the time, Marin Katusa. Hey, I want to start with something that many people don't know. Because when you hear the name Marin Katusa, you're thinking to yourself, man, this person must have had $100 million when he was born, because he's done it so early. It's probably inheritance money or something like that. But I know the true story, and I know that there's real value in it. Can you share with us how you started and how you got where you are today in kind of a 5-minute nutshell?
I'm born and raised in Vancouver, Canada, and I did have one lucky fortune. Vancouver is the epicenter of the resource sector for financing. So we'll come to that. That came into effect later on in my life. But, I was always a hardworking, diligent student, got an academic scholarship to university. I excelled in mathematics and chemistry. I graduated from there, started out actually as a high school math and physics teacher. From there, got into the Ministry of Education, marking the provincial exams, and then started teaching post-secondary calculus courses. And basically through that, I got really interested in tungsten, and I became the guy in Vancouver where all of the newsletter writers and management teams would come to my research for tungsten. And one of the presidents of a tungsten company that was actually in Portugal got a hold of a report that I wrote, 300-page report on all these deposits. And that was the first ever financing I did. It was the first ever private placement I did. And, I became known as Mr. Tungsten back in the early '03. And from that aspect, I never heard of Doug Casey or Rick Rule. Later on, they became my partners and mentors, and now I manage Doug Casey's money. So it became, you make a lot of mistakes early on in your career. I'm not the smartest guy in the industry, but I think there's very few that will argue me on when it comes to the effort and hard working and discipline in this sector. And through that, I was able to build an incredible Rolodex of the best geologists for different types of deposits, the best engineers. So, through the last 15 years, I've been to over 100 countries and traveled. Early '04, I became one of the main financiers in uranium. That was a great run. And then, in '06, partnered up with Jim O'Rourke and Rod Shire, became the founding 4 directors of what eventually became Canada's 3rd largest copper producing mine. and at the same time was the largest investor in Quadrilla. So, what I'm trying to, in my writings, I've made a lot of mistakes, and I write out my whole thesis, my framework, and people can see. And I believe skin in the game. One big aspect. So many newsletter writers or fund managers, talk a big game, but they don't own any of the stock that they're telling their followers to buy. And I think that's complete nonsense. I can assure you that not a single subscriber of mine has more money into any one of my recommendations than what I put in at the same time and at the same price. That's the absolute key to anyone. When you're listening to someone, what is their cost base versus what is your cost base? And if you're in together at the same price, together you have skin in the game. And that's what my whole thesis of my business is about.
Marin, I want to ask you, because this is very interesting, and it's an intro to what we will focus on today, because your entire niche is the natural resources industry, which had an amazing run between 2009 and 2011 and has totally decimated between 2011 and 2015 when we talk about precious metals. And obviously there's much more to natural resources than just gold and silver, and we'll talk about more broadly about other opportunities. But I want to start with the latest and most updated news, and this is the rate hike. The Fed just raised rates by another 25 basis points. The Fed's fund rate sits at 2% right now, and the recent rate hike, unlike the 7 previous ones, did not generate a gold and silver rally, or it generated just a brief one for a few hours, but then prices plummeted. Many talks in the media and alternative media even more about contracts in the COMEX being over leveraged by 250 to 1, a paper manipulation, a price suppression scheme. What is your take on why gold and silver currently, as we're doing this interview, have fallen by a lot since the rate hike, and it looks very much like a violent smash?
So as I published to all of my readers early on, I stated that these rate hikes, which were very well known, there was no secret, it wasn't a surprise, in combination with the American foreign policy, would push gold and precious metals lower. Remember, it's not just about the Fed rate hikes. It's also about, the looming discussions about the trade wars, sanctions, tariffs. There's so much, confusion in the markets. And with Trump's twisting and tweeting, nobody knows what to make of the American foreign policy right now, and he's buddying up with South Korea, alienating his South Korean allies, but then partnering up with North Korea. But you know that can just pivot just as quickly. So, and you look at countries like Russia and China, who are using this weakness to consume and buy more and increase their exposure to gold. Unfortunately, countries like Canada have sold all their gold and they have zero in their reserves, nor are the Americans growing it. So, there's a multiple effect here, and I think for the near term, you'll see more pressure on gold.
Very interesting. Okay, let's take a look here at what happened in 2016. Wealth Research Group, my newsletter, started in January of 2016. I actually launched it because the Fed raised rates in December 15th of 2015 for the first time, and gold bottomed at 1,053 per ounce, and we were able to cover 12 different companies in 2016 that more than doubled. Some of them went on to gain as much as 450% in 8 months. That 8 months period brought about a new speculative era for the mining shares, but by September of that year, so 9 months after it started, it was already peaked. It's already gone, and many people obviously were not positioned in January, February, March, April, or May, and only got in to start building their positions because they were cheap as well at that time in June, July, and August, and it's been nothing but going downhill from that point for almost 2 years, for two straight years now. So looking back, Marin, what was 2016 to the resource sector?
What I believe and what I published at the time for a lot of our subscribers is the pressure from, let's call it the fund managers or the professionals in the industry. They suffered a 4-year serious bear market. And as these stocks came up, you have to be very careful in which type of companies. They're very capital intensive. A lot of these companies need so much money to build these projects before they develop any cash flow. And I call it the trigger effect, where so many fund managers, their NAVs, their net asset values on their funds started to go up, and people who've been, punished for 5 years were basically redeeming, and that caused a trigger effect. Another major effect was all of this selling from these fund managers, and at the same time, these ETFs, for example, VanEck at that time started rebalancing their ETFs for these, the junior minor ETF index, where they're actually having majors, multi-billion-dollar market cap companies enter a junior ETF, which made no sense. So never before in the resource sector has so much money been managed by so few. And you see the effect of whether it's the last remaining fund managers who are having fund redemptions to deal with, or these ETFs with rebalancing their indexes. That's caused significant pressure in these companies. So all of those things combined, plus people really believe that, with a Trump winning, that things would go, fast track, but we haven't really seen that on the permitting side or the development side. So it was a perfect storm on all the things that could go wrong for the resource sector.
Interesting. So basically, people were pricing in much more flexible regulations, but since it hasn't transpired, they are either became bored or they want to move on to another sector because they're.
Think about when you see the big index, the S&P or the FANGs. You look at Google and Facebook. There was so much money plowing in. People are saying, "Geez, do I really need to be a contrarian at this time when I can make so much easier money?" And that's the beauty. You want to be where nobody is to get the true rock bottom prices. So, ask yourself this, if you're going to think a value investor or a Warren Buffett or a contrarian investor, you're not being a contrarian investor buying Tesla, even though people think, the company's non-profitable. It's a very expensive stock, whichever way you want to look at it, but it has a lot of attention. Where you want to go is a sector, or specifically an industry, that is getting no attention, because the cure for low prices is, in fact, low prices. And you see that in many of these sectors and companies. And right now is the perfect value investor standpoint. This is where a lot of people don't even realize that Warren Buffett is buying a lot of these and exposing himself to these sectors. And no one talks about it because it's not popular. It's much more exciting to talk about Netflix or Amazon or Alphabet or, these different, these hot stocks. So that's another aspect that the sector has really been competing with, because you're competing for dollars.
Now, I want to talk about how people should look at their portfolio when it comes to natural resources. When you purchase or when you invest, when you place an order and you become a shareholder, a partial owner of a resource company, what should you expect in terms of the time frame for this investment to become a fruitful one? Should you start out with a big position, or should you start small and employ dollar cost averaging, or employ some sort of a hedging strategy where you short other companies or short other indexes? How sophisticated should people be before they decide to invest in natural resources? Because obviously, in an industry that can go up and down by hundreds of percent in 1 year and go down by tens of percent in 1 year, this is a very sophisticated environment, and people should always mind how they're diversified to other sectors and exposed to other sectors, to the upside of other sectors, and also make sure that their position sizes are very, very strict and firm so that they can avoid any catastrophic losses. How, in the framework of what I just spoke about, how do you personally prepare for investments in this sector? What do you look at first? And obviously, I know that you share the same conviction as mine, where the management team is basically the barometer of the investment, and everything kind of starts from there.
So the first thing that, not everybody in who's an investor can go and get to know management and all that. And that's part of the advantage of, I view my newsletter as my personal journal that everyone can see what I'm doing at what prices I'm buying. So I'll give you a great example, a real-time example of a story called Nevsun that I wrote about. I first published it in June of 2017. And I said, I've been to the asset, I know the management, and I gave them a long backstory of how the story developed, the previous management team who used to vacation at my place in Europe. So I knew the asset really well, funded them for many years. And I told my subscribers, I go, look, I believe the market's going to get weaker towards the end of the year. So I have something called the Katusa matrix on how to buy. You buy your first tranche of 25% at a set price. Then we let to see how the stock develops. Now, I personally will not buy a stock unless I've really spent a lot of time with management answering all my questions, and I have my own due diligence. And the due diligence process has my own geologists, my own engineers, and it costs hundreds of thousands of dollars on a due diligence on a single project. Doing the site visit, understanding the risks and the politics, the development, the infrastructure, all those aspects have to be modeled in, and I publish on all of that. Then I said, take your first position under $3, but then I believe towards the end of the year we'll be able to buy another tranche of 25% under 250, and I publish all of that on how to do it. And it's a nice matrix that people can follow it. And about a month ago, the stock had interest as a buyout, so the stock was up over 70% for our subscribers. And then that's when I send out an alert and say, look, I don't know what's going to happen on the buyout, but we're sitting on a nice 70% gain for a year in a really tough market. So let's do the Katusa free ride. Even though I believe in this asset, if I have a chance to, sell half of my position or 2/3 of my position and get a free ride on a third or a half, that is all about mitigating my risks. So that's what I published to my subscribers. And now everyone's sitting on a Katusa free ride, which means you've taken all your principal, all your initial capital out, and you have free stock. And I do believe the stock will do better, but it's about mitigating risk because we are in such a risky sector. And now if I can build up a portfolio of really top quartile assets, like the best assets in the world, run by the best management teams, that pay me money through a dividend or a royalty, and have all this upside at no cost to me because I've recovered my capital, that's what I call a perfect portfolio. So that's the answer to your question is how I play.
And obviously, this all goes on in your newsletter, which we'll get to later on. And I want to kind of expand our topics here and go outside of just gold for a sec. The gold to silver ratio, it is embarrassingly high, and I want to ask you: is this the new norm for the 21st century as silver's kind of demonetized itself, apart from instances where it's what has a lot of investment demand for coins and bars because people are afraid of the fiat monetary system. Most of the time, every day, silver miners sell their ore to industrial purposes, and it looks like the premium that silver had for thousands of years is kind of gone. Is this something we can expect going forward, or is there a correction event here that will send it towards the historical 16 to 1, 20 to 1, even 30 to 1 would make silver worth double what it is today? So where are you with silver?
So I am not a silver bug, nor am I a gold bug. I'm not a copper bug. I'm one thing, a profit bug. All I care about is making money. So using historical ratios like that, I made a lot of enemies about a decade ago because I was a big believer in shale gas and shale oil because I'm a big believer of incorporating new technologies, which are actually deflationary. And what I tried to explain at the time was people were using the historic ratio that, natural gas should be 6 to 1 to oil because on an energy equivalent, that's the energy equivalent to the price should be 6 to 1. And I said, well, that's historical. With the new technologies, gas is becoming a byproduct. And as they discover more shale fields, they'll be able to unlock more gas. And we saw it go up to, over 50 or 60 to 1, in fact, on the shale gas at its low. So what I'm trying to get at is as technology changes and as the use, for example, in the silver cases, you've seen, at one point over 50% of all silver was used for photography. Well, that's pretty much been eliminated. And now it's more into solar panels. 10% goes into solar panels. That's going to be increasing. But my point is using historical ratios like that it is almost to the point of using a horoscope. Be very careful about that. And I don't necessarily buy that. To me, it's about supply and demand. There are certain silver projects that I'm very interested in buying a big chunk of because they're world class, run by great management team whose cost is at the same price as you can buy in the market now. I've done the site visits, but the point I'm trying to make is using general metrics like that, I think, are very dangerous.
Now let's talk about one metal that is suffering from a lack of discoveries for at least 20 years, and that's zinc. Um, uh, what is the change that needs to occur for companies to start finding zinc? Why is it so hard to find a major discovery anymore?
Well, my good friend Richard Ward just sold his company for $1.8 billion this morning. That's the Taylor deposit in Arizona. It's called Arizona Mining to South 32. So if you do develop a world-class zinc deposit, the majors will buy you out. Zinc is, generally speaking, a byproduct commodity. And there were so many, if you look at Glencore, which is the world's largest trader, they vertically integrated themselves to the point where they can control not just the production of it, but also the sales aspect of it and the smelting of it. So you got Glencore in Canada, the largest smelters, Teck Cominco when they bought out the Cominco assets, Red Dog. So you look at all these different aspects, and because it's not a primary commodity, it wasn't like copper or gold where people were looking at, just exploring for it. And the fact is it was very effectively explored in the past. And as the galvanization in China opened up, the big stockpiles and these commodities were there. There's some very big zinc deposits in the world that were slowly depleting. So we're entering now the phase of the zinc that the majors are going, we got to backfill our portfolio. But you got to be also worried looking at any of these smaller zinc deposits. How close are they to a smelter? So zinc, because it's so, what's it trading at about $1.40 a pound this morning? So you got to look at it and go, wait a second, what smelter do I send it to? That smelter is most likely owned by a major zinc producer. So any of its byproduct, do I get the credits for it? Well, the lead or the silver that come from it. So be very careful about, there's a lot of zinc deposits. There's no shortage of zinc deposits. There's a shortage of world-class economic zinc deposits that are economic, that will feed into the specific zinc smelters. That's the key aspect to understand here. So zinc's a really interesting aspect. Plus, there's new technologies coming into the zinc sector that I think are going to surprise a lot of people, that will make many smaller deposits uneconomic.
Very interesting. You talked about China, so I want to really make sure that I hammer this question home. China's mining industry is humongous, and it involves many government entities and private companies. For the most part, for investors, how detrimental is it that the Chinese government can mine so much on its own soil without allowing investors and foreign investors access to fund these companies, to invest in these companies, and actually profit as these companies bring economical deposits to the surface? In other words, has the game become a lot harder now that China is able to have a robust mining economy of its own and basically supply much of its consumption by using private companies or government companies that we don't have access to?
So the interesting thing about China, we call them SOEs, the state-owned enterprises. A lot of people don't know that China is the largest producer of gold, but rather, unlike the Americans, who are like, you look at Nevada in itself. If Nevada was its own country, it'd be one of the largest producers of gold in the world. We don't sell to the American government when you produce in America. You sell into the refinery. You sell into the international market, whereas in China, they sell to the government. Another aspect people often forget that China is one of the world's largest producers of oil, yet are the largest international buyer of oil today. A lot of people forget that China imports more oil than America. So that's a different aspect. They don't export any of their oil, they consume it all. And even at that stage, even though China has such a large oil and gold sector, they consume so much, so half of the world's copper that's produced goes to the Chinese smelters. 2/3 of the recycled copper in the world goes to China. But that's an interesting aspect where the Chinese government, because of the air apocalypse, have come out and changed the regulations, saying, no, we are not going to accept second and third rate copper recycling, and we're going to classify it at the export gate, not at China. And that's part of the reason that's keeping the copper market afloat. So China's really changing the rules on the pollution domestically, which is in fact propping up the zinc market, the copper market, and these different aspects. Whereas 10 years ago, it wasn't about the environment. It was produce the commodity at all costs because we need it. Now it's about we have to meet the government set standards. And if the commodity can't meet that, then that mine or that smelter or that refinery will shut down. And we've actually seen it. A lot of people say that you can't trust, the laws out of China. I've been there many times, and you're seeing on the ground changes happen to the industry. Hence why we're seeing the strong zinc and copper markets today.
Very interesting, Marin. And I want to ask you, what are some of the resource sectors that are the cheapest in absolute values, in relative values? If you just look at them and say, that is absolutely ridiculous, it cannot stay this way. What is the number one commodity or resource that you say this is unsustainable? And not only is the change going to come, but it's so not only is it inevitable, but it's right now. It's imminent. This is as close to the bottom as I can figure for this sector.
If I understand your question, it's more of a question of not if, but when. And I would say, no doubt, the uranium sector. No other sector is as hated, unloved, beaten down, as much production shut off. Imagine if I told you that 2 of the 3 largest and highest grade gold mines in the world shut down because they're not economic at current prices. That would really catch your attention. Or what if I told you that Saudi Arabia today, 10% or 11% of the global oil market shut down all their production in oil? That would catch your attention. Both of those circumstances are currently happening in the uranium sector, and yet nobody cares. And that's exactly what I mean. When nobody cares, that's when you can get world-class assets on dimes on the dollar and turn a dime into a $10 bill. That's how the uranium market is set up. It may take a few years. And you don't need to buy 25 uranium stocks. You buy 2 or 3 into your portfolio with the best management team that aren't a Johnny-come-lately. What I mean by that is run by a team that also have a technology and blockchain and marijuana company. No, you stick to experts in the field who've been there when uranium just a decade ago was $137 a pound, and just recently, today it's $22 a pound. That's a sector that I think is really beaten down more than any other commodity.
And obviously, anyone who's been there at the 137 and survives to all this drop to 22 is very credit worthy and very astute to be able to manage a company like that. Marin, I want to ask you regarding a report that came out of one of the major banks, and it just showed the ratio between gold and other equities, and it just showed that gold might be in a downtrend that will take another 10 years to play itself out. In other words, gold might not be the best investment going forward. Yet, we see it up 22% in less than 3 years, confirming it's a bull market. But if you look at it from the aspect of the previous bull markets for gold, the one that has been least profitable ended with a 70% rally. So if you take 1,053 and you add 70% to that, that's over $1,700 per ounce. We're at 1,300 today, just about. So there's a huge $400 per ounce gap to just the most conservative bull market we've seen. Is the fact that we're 3 years into this and the spot price is up 22%, yet if you chart it and plot it compared to other bull markets, it looks very modest and very moderate. Is this the reason why the junior mining sector has basically not even confirmed that it's in a bull market? In other words, is the market waiting for a higher gold price before the junior mining sector becomes more appealing to investors, or does this more have to do with what you said, where the general equities, the FANGs, and just about all the quality dividend companies in the world are performing so well that why risk going into a niche sector when there's good money to be made just by following the index?
So one thing I want to make sure everyone truly understands, the price of gold and how a junior gold explorer trade are actually uncorrelated initially. See, most of these gold companies don't have any gold. They're looking for gold. So from a mass psychology standpoint, yes, if gold's at $1,800, you'll have the general index funds and you'll have the generalist funds looking to explore. But we've had, for example, a 10-bagger, meaning our subscribers to the Katusa newsletter made 10 times their money on a company that has already found the gold. So this stage of the market, which is the stealth phase of the bull market, when nobody's talking about it, I don't need to take exploration risk. Hence, the price that gold is trading at and the company that I'm looking at is irrelevant to me. I can buy drilled out deposits run by world-class management teams and take literally zero risk on the exploration side because other shareholders who've been beaten down over the last 10 years have taken that risk and the company has advanced their projects. But because everyone's been bored over the last 10 years in the sector, I'm able to pick up a project that is 10 years more advanced and it's trading at a dime of where it was just 6-7 years ago. I'll give you a great example of one in our newsletter, the Pebble project. Everybody hated it. I wrote it up at 45 cents. I became one of the largest shareholders. And within 12 months in our newsletter, it went to $4.50. I put out an alert, take a Katusa free ride. Whatever happens to the stock at that point, once you take out all your initial capital and then you just sell, remember, as I have my matrix in buying, I have my matrix in selling also. That's what you do in today's market. You don't need to take exploration risk because I can buy advanced assets trading like they are a junior speculative stock with no gold. That's what I'm doing with my money right now.
Marin, let's talk about your newsletter a little bit. What is going on right now? What's the most important thing for people to know with regards to your newsletter, and where can people find your work?
Yeah, so I publish everything that I'm buying and what price I'm buying. There's no secret in the industry that I'm one of the largest financiers, and I allow my subscribers to get into these financings. And if you're accredited and you go through it, you get to expose yourself to warrants. It's my way. Remember, I was a teacher, 20 years ago, and sitting there listening to guys like, Rick Rule and Doug Casey and Eric Sprott, all these legends in the business talking about the financings and the warrants. I went, wait a second. They never talked about this in the CFA program or any of that. So my goal was one day I want to get there, and I'm there now. And the cool part of it is I allow my subscribers and I tell them what I'm doing, what price, and I give them a link or a phone number to a company. And if they feel that it's something they should be doing and the risk is right for them, they can get into a financing at the same terms as the same price as myself at the same time. So it's not like I'm getting in early. And more importantly, when I tell people, hey, take a Katusa free ride, I give them 3 business days to sell before I sell. Because in this game, if you're buying strong assets like the Nevsun example or the Pebble example, we had a big buyout with Altera Power, which I was one of the largest shareholders, and it was a massive win for my subscribers. I said, hey, I'm in no rush to sell. We have a buyout offer from Interjex. You could sell now for a 75% gain, or you can just sit back and take the Interjex stock. So that's the type of what I do in my newsletter. I provide videos. I have a studio in Vancouver. I employ some of the best geologists and engineers who are in the Hall of Fame. These aren't young buck, inexperienced geologists. These are guys who are literally in the Canadian Mining Hall of Fame. That's my Rolodex, whether it's Roland Schlenker or Jim O'Rourke. These are the guys that do the back work for me. Interestingly enough, guys like Doug Casey, who also runs Casey Research, they're not allowed to buy the stocks that they talk about, and I think that's ridiculous. Why would I follow somebody if they're telling me to buy a stock but they say, no, I don't own it? Well, I want to be in with someone just like you want to be in with the management that own their stock. It should be the same thing for any fund manager or newsletter writer. That's my belief. So when I go to a site visit in Brazil or in the Athabasca Basin or somewhere in Africa, I take my film crew with it and I allow my subscribers from their phone or their computer to see exactly what I'm seeing. When we go underground, when we go to the smelter, when we go to the refinery or the mill or the core shack, they see everything that I see. And I do it because I love what I do and it's fun. So that's what you get to see. It's at katusaresearch.com. It's all there, and everything I've ever published is on the website.
Legendary fund manager Marin Katusa, I really want to thank you for taking the time today. And this was just the intro. We'll have a series of interviews with you going through 2018 because there's many things to talk about here. And what I really love is that there's many cheap assets that are available, so that people need to really prepare intellectually, mentally, and do the legwork in order to find them. But they are out there right now because this sector has been plummeting for 2.5 years, and the valuations are quite incredible. So Marin, thanks again for taking the time. KatusaResearch.com, and we'll chat soon.
Thank you.